Welcome back to Compounding Wisdom with Paul and Gio. We missed you last week, Paul. You look tan, you look great, and love your
Thanks.
shirt, my friend. Where were you last week?
We were in Guatemala.
Oh,
We
wow.
went with some clients and friends and had a great time, rented out the whole resort. People of Guatemala, amazing. I did not realize Guatemala City is the largest city in Central America, over 4 million people. So the
Really?
population density was unbelievable. And I kept thinking of you. I tried to capture a picture when we were on the road. It said Guatemala this way, El Salvador that way. And I was like, oh, mi hermano. So I tried to capture a picture, but we had a great time.
Mm,
We went sail fishing out in
mm.
the Pacific Ocean. Great experience, tons of fun, epic experiences, great memories. We laughed, we cried. It was amazing.
Oh, awesome. I think you have some pictures that you shared with me of your fishing expedition.
Yeah, there
What
you go.
what what what's happening here?
So those are sailfish. We went sailfish fishing for 3 days.
Mm.
The ideal is you catch a blue marlin. We did not get a blue marlin, but we caught 23 of those sailfish,
Oh,
which are
wow.
monsters. And then we caught a mahi mahi as well, which was really fun. So the food at the resort, the service at the resort was second to none. But the best meal I think I've ever had in my life is we caught a mahi at 10:10 on Monday, and by 11:22, 72 minutes later, we're eating fresh ceviche on the boat,
Mm,
and it
mm.
was unbelievable. It was so much fun.
So cool. Wow. I've never been to Guatemala. Obviously, I was raised in El Salvador and it's a neighboring country. I didn't know that so many people went there to fish. Our good friend and colleague, Nick Frohart, he's gone there multiple years and he has a lot
Nine.
of friends. 9 years. Wow. Wow. And I think it just started with 7 guys. Now it's
48.
48. That's a lot.
Yeah,
That's a fun time. So did you watch the Super Bowl in Guatemala?
we did.
Oh,
We
wow.
did. And you know me, bleed purple, Minnesota Viking fan. If you had told me a year ago, hey, Sam Darnold's going to win the Super Bowl, I'd be like,
Mm,
I don't believe it. He's on the
mm,
Vikings finally. And then if you would have said for another team, then I'd be like, oh, now that makes more sense. So
mm,
I'm happy for the Seahawks, happy for
mm,
Sam Darnold. God bless him. But yeah, as we watched it and had a great time down there.
mhm. A lot of people watched it. 125 million people watched it, even with the controversial halftime performance. I think there were a couple of shows that were happening at the same time, but the NFL is not a charity; it is a business, and they want to expand their influence internationally. And so they got the most popular artist in the world outside of the United States, and so a lot of people watched. Interesting enough that the NFL what was I think like a 501c3.
501, yeah.
Yeah, it was. But that went away around 2015, and so they are 32 entities trying to make a
Yeah.
profit. NFL $23 billion enterprise and continues to grow. So really fun to watch if you like defense. And so it's a pretty boring game for some people who don't enjoy defense. Big fan of defense.
Defense wins championships. You saw
Yeah.
that. And with that being said, it's interesting. We're in Guatemala. They speak Spanish. And
Mhm.
at the resort, when the Bad Bunny show started, they turned it to the Turning Point USA station.
Oh, really?
So that was interesting to me. They speak Spanish and they're like, no good, no good. And they moved it to the Turning Point. So
Yeah. Interesting.
I thought that was pretty fascinating. Yeah.
I'm a big fan of Bad Bunny. Grew up Hispanic. Listened to a lot of Spanish music. So big fan of Kid Rock too. I like all music. I like all music. Okay, so this is an investing show, so let's get on to the show. We're going to cover three big topics. Inflation came out today, so we'll cover a little bit about that. Jobs reports as well. A lot of companies are down, a lot of companies are up. We'll talk about both of those flavors today, and then we'll end the show as we always do with wisdom of the week. We are recording this on February 13th. It is 1:15 p.m. Central Time. Information we share is subject to change. With that, let's start with inflation. So CPI rose 2.4% year over year in January. That's down from 2.7% in December. Um, I think uh, I have a chart here that shows kind of the breakdown of where all the inflation came from. Let's see here. Oh, kind of breaking down the CPI report. This is a great chart from CNBC. Um, the big ones where gas went down a little bit, electricity went up a little bit, actually quite a bit. But these numbers fluctuate a ton, enough to say that they were kind of in line with what a lot of people well, actually it was lower than a lot of people expected, but just like all the items, less food and energy, kind of what you expect. Airlines continuing to charge more, so the discretionary spending, that's still increasing. Food is kind of between the 2 to 4%, and then surprisingly, tobacco continues to have kind of an uptake in pricing. I was actually listening to the Philip Morris International earnings call, and they see a lot of growth still in they call it non-smoking segments, but enough to say that a lot of people still smoke here in the U.S., abroad more so, and so they see that a whole lot. So, what do you see in the numbers? What stands out to you, Paul?
Well, first thing I look at is the piped gas service, and I think about like our friends at Tenasca, and I wonder if with that cold weather that came through and the unseasonable storm, is that what caused that spike? I don't know, but that's what I
Mm,
think of initially, an anomaly from a seasonality and temperature climate standpoint. Number two, you keep hearing about how this economy can't do what it's doing. But again, I just got back, airlines packed, eating out, packed, can't get reservations. People just continue to spend. Discretionary spending's still up. 70% of our economy is based on consumer spending. So again, things continue to point to the economy growing. But man, seeing inflation back in that 2% range, that is awesome. We want to
mm.
see that back under 3%.
Never want to be a downer about this, but there is a big asterisk on the report. We mentioned it
Sure.
on these shows before, but because of the government shutdown in the fall, the data wasn't collected in October. And so, if it was Moody's, they estimated if the data from October was included, CPI would be closer to 2.7%. So, it wouldn't change what the Fed is considering doing for the next couple of months, but it was definitely lower than people expected. And we'll finally see the real results after that 1 year lapse. Hopefully, the government doesn't shut down again. With that,
And
let's move
still
to,
still better than 3%. Still better
yeah,
than 3.
exactly. Yep,
Yeah.
yep. So let's move to jobs. So non-farm payrolls, which measures total paid U.S. workers, not including farmers, that increased 130,000. Expectations were for 5,000. So this is good. Unemployment ticked down because of that to 4.3%.
Mm.
That is encouraging. A broader measure that includes discouraged and part-time workers fell to 8% from the jobs report. A lot of jobs came from the healthcare industry. 82,000 jobs came from there. Construction also added 33,000 jobs. What I wanted to just show is just we continue to be in this low fire, low hire environment. And so
Mm.
we see people not getting laid off as much. That's the orange line, about 1% of
Wow.
employment. And but then we have about 2% quit rate as well. So people are kind of sticking with the job that they're in. Um, so so that's good for the overall economy. When unemployment does spike and people don't have jobs, that's when we're actually talking about recessions. I always think about that quote: if your neighbor loses a job, it's a recession. If you lose a job, it's a depression. So but if you are looking for a job, It seems there's less job openings available, but at least here in Nebraska and Omaha, unemployment rate is below 3%. It's historically low here, and so it's a very competitive labor market here. What do you see in these numbers, Paul?
Yeah, it's great. One, great minds think alike. I wrote that same quote, recession, depression. The workplace is in a great place from our perspective. The economy again is doing well. So, we believe a soft landing is still very much possible. The stability is preferred over irrational excitement or enthusiasm about what could or could not happen. Unemployment in the 4% range is fantastic. So if you have an optimal or optimized workforce, likely job sentiment is going to be lower, because if everyone is working, the market's fully deployed, it is going to have less opportunity for new jobs or sentiment. That makes sense to us. And frankly,
Mhm.
back to your comments on recession, depression, employment is the backbone of our economy. So if we have employment stability, workplace stability, people are going to be buying homes. People are going to be buying cars. They're more likely to make those more what we call outsized financial commitments. And again, Americans are spending money. Economy wins, everybody thrives. So all these things are just pointing again in a really positive direction.
Agreed. The Federal Reserve has about a 10% chance of cutting rates in March. So as long as Jerome Powell's in the helm, I don't know if they're going to cut rates. Markets are pricing in a roughly 2.5 rate cuts in 2026. First cut likely coming in June. That's a 50% chance there. So that's what we wanted to cover on jobs and inflation. We do want to touch on the markets. There has been a lot of chatter on what's going on in the marketplace. S&P 500 is positive today, probably because of lower than expected inflation. But the mood has shifted in the marketplace. The mood has shifted. A few months ago, markets rewarded companies for massive AI spending. Now investors are anxious about it. We see hyperscalers planning on spending $700 billion in capital expenditures. That's almost a doubling of last year. And that was, I think I saw in the Wall Street Journal, that's about 2.1% of GDP, which is more than what the United States spent on the interstate highway system, on what we spent on railroads, and what we spent on the Apollo mission. So these are massive scales, which is reverberating across the the economy. Even with Alphabet, Meta, Microsoft, they're all down about 2% year to date. Amazon's down 13%. Apple's down 5%. They're not even participating in the CapEx spend. They are very boring. They're actually outsourcing Siri. I think we talked about this last time we spoke. They're outsourcing Siri to Google to kind of revamp that. And they are seeing record revenue just across the board. I think it was this week that FTC was just questioning Apple News and their bias towards probably more liberal um, publications, and so that's what the narrative was for Apple being down 5%. Bitcoin is down 25%. I think a lot of people thought that this administration was going to be, all in Bitcoin, and they are big proponents of it. I mean, the White House, I think they have their own cryptocurrencies, coins out there. But Bitcoin's down 25%, and then software companies, some of them are down 50%. Salesforce, Adobe, Intuit, and some that you might not even consider just straight software like Palo Alto, CrowdStrike, they're down about 30% from their all-time highs. And software was about 12% of the S&P 500 that's at the start of 2025. Now that's closer to 8% because of this massive pullback, mostly because investors just think that AI is just going to disrupt these business models, and they're selling first and asking questions later. And that is the mood that is happening, and that's bleeding into private markets for private credit specifically, which finances many of these high growth software companies. And I listen to a lot of private credit earnings calls, and they obviously they're talking their own book, but they're saying that these companies are still very profitable. They have a lot of cash on hand. And ultimately, they're not making a bet on AI or data centers or chips. They're making a bet that these companies will repay them for the duration of their loans. That's what bonds, um, That's how you get your return on bonds. They pay you your interest and you get your return on principal, and that's it. So it's definitely less risk there. But investors at this time are just putting both of those together. And then again, the financial firm this week also announced that they are uh, using AI to provide financial planning help to wealth clients. And that meant that LPL, Charles Schwab, a lot of wealth companies, publicly traded companies, are down 3 to 5%. And again, it's just this narrative that AI is just going to disrupt every single business model out there. Your thoughts on that, Paul?
Great insight. One, that narrow or isolated pain in some of these sectors doesn't change the fact that the broad markets are at or near record highs. So I think that's super important. Like I think you shared with me either yesterday or this morning that the equal weight is outperforming the overall market, which the last few years that's not been the narrative with the Mag 7 and the concentration of returns. And I looked it up. The Dow's at what, 50,000?
Yeah,
When I
there you go.
started my career when I started my career in 1997, the Dow was at 7,000.
Mm,
So it has gone up 7x in my 28-year career, which is just mind-boggling. And then, you talked about some of, again, that isolated pain. That's such a great reminder, as you like to share with all of our clients, even though the S&P 500 or the index 500 is positive 74% of the time, 3 out of 4 years, in any
mm,
given year, 30 to 40% of those individual stocks are down, which
mhm.
makes that so much more difficult to pick those individual winners versus just riding the broad markets.
Yep, yep. 7 out of 11 sectors this year so far are positive, and even with the overwhelming number of sectors positive, the S&P 500 is barely positive. They were actually negative at the start of the day, but S&P is up today, and that's mostly because the S&P 500 is heavily weighted to technology. 33% of the S&P 500 is in tech companies, but if you look outside of technology, and I'll show a chart here briefly, and go down the cap, meaning smaller companies, mid-sized companies, they're positive. International companies are positive. U.S. dollar is down. I think I saw 5 consecutive days. So that's a tailwind for international companies. So all of this to say, there's a book, The Tale of Two Cities, Charles Dickens. I'm pretty sure
You
it's
might be, you're probably right.
Yeah, and it starts with, "It was the best of times, it was the worst of times," and I think this is what we're seeing in the marketplace right now. So if you're in Bitcoin or high growth, stocks, that's really hurting. If you're more kind of steady Eddie value companies, that is doing really well for you. So diversified portfolios are doing really well this year. So
It was
here's a
Charles Dickens. Nice job.
there you go. There you go. Trivia winner, Jeopardy winner over here. You can see here that these are the sectors right here. Who would have thunk it that energy was going to be up 21% year to date? This probably was not in your bingo card. And then technology down 4.5%. You can see there at the bottom, discretionary financials, kind of what we just talked about earlier today in the segment. But boring consumer staples companies. This is your Pepsi. This is your Procter and Gamble, and then energy companies, material companies. I think that's been a trend in the last year. Gold, silver, copper, all those companies that are mining. That's been a tailwind for them. Industrials, the most diversified sector of all, they're up 11%. There is this idea that technology, they were swallowing up all the earnings the last couple of years, but now the earnings are kind of going to be more broadened out to all these other sectors to see how they're going to harness the power of AI. And all the data that we see is in the past, all the financial statements, income statements, cash flow statements, that's all data from the past, but all the value is in the future. So people are trying to guess right now where that value is going to come from. And um, yeah, if you're guessing, it's really hard to know. You're relying a whole lot on luck. But if you're diversified, stick with a plan that tends to work out over long periods of times. Low cost, diversified indices. So, well, from a long term perspective, what's the message here, Paul?
Well, yeah, I think you reinforced it again. The long-term message is diversification tends to win. Day to day, week to week, markets are volatile. Day to day, we talk about often it's a coin flip. Year to year, 3 out of 4 years are positive, but decades over day.
Yep, yep. I appreciate that, Paul. Another thing that we're seeing is, for the first time in a while, value stocks are beating growth stocks, and by a pretty large margin. I think I was looking at the S&P 500 value versus the S&P 500 growth. I think the spread there is 6%. A lot of the
Wow.
reasons, because of what we just talked about already. Again, it's very short term. When you kind of zoom out and you look at value versus growth, growth has just been beating
Oh, wow.
value
Yeah,
by
that doesn't
over
surprise me.
300%. A big reason why, information technology is a big component of the S&P growth index. About almost 50% of the index is in the information technology sector, and for good reason. I mean, when you look at just earnings growth, technology firms have just continued to grow their earnings. So yes, they're more expensive than before, but their profit margins are higher than before. Their earnings are continuing to grow. So fundamentals have been very good for them. So again, I think right now what we're seeing is just kind of companies, just the market's just taking a breather, kind of realizing that there might be more value outside of technology. That's one thing that we're seeing. Another thing that maybe the value, um, rotation might continue for a ways, mainly because Russell 1000 value relative to the Russell 1000 growth it's still trading below its long-term discount rate. So here's a good chart from Guide to the Markets, just showing uh, that the Russell 1000 value tends to be at a 30% discount relative to growth. For the last 5 years, it was trading at a 50% discount. Because of this recent spike in returns for value, it it's still at a 36% discount. So this might mean that it's still a pretty good value relative to growth, and it could continue to move forward. And these rotations could last longer than some people might think. So this is just showing you, when growth does outperform, that's the gold. When it's dark blue, that's value outperforming. And for the longest time, in the last almost 20 years, it kind of seems like growth is just continuing to beat value. That's what we just saw in the last chart, over 300% outperformance in the last kind of 15 years. And so there's a lot of tailwinds happening in value. At so that's what we're seeing right now in the market. Your thoughts on that, Paul?
Yeah, those are great charts. One here, like actually leave that up for a second. You can see on that chart, technology boom, far left side of that chart, growth expanding. That far left side, massive overperformance for growth. Then no surprise, tech bubble burst, 9/11. There's fear prevalent in the market, looking for stability, value wins, post 9/11. Then all of a sudden, financial crisis, boom, growth rallies post financial crisis. And then here we go again. The last couple of years we've seen growth overperform. So that's interesting. It just shows that cycles can and often revert. That's why we encourage clients not to chase gains. That's the surest way to underperform the market. And
Mm.
as you like to say, cash is king. We love profitable companies that are generating a ton of excess cash. And then can you go back to I think it was 2 slides prior? Yeah, that's such a great slide. And what I was looking at here, one, doesn't surprise me to see growth way overperform value. But what's interesting to me is look at the drawdowns. So if we look at the chart, and it's hard to see the dates, but I think that's, COVID there. And then we see the interest rate increases in 22, 23. Then the tariffs, look how much more dramatic those drawdowns are off of that orange line versus
Mm.
the blue line. So again, just something for clients to keep in mind when and if and when we do see future corrections or anomalies in the market.
Hmm. For sure, for sure. Okay, with that, we do always like to end our segment with a wisdom of the week. And this past week, I reviewed Same as Ever, a book from Morgan Housel, one of our favorite authors. And what his one of the quotes that he had in the book kind of resonated with me this week. He quotes Montague from the 70s, says, if we wish to be happy, this could be easily accomplished, but we wish to be happier than other people. And that has been around for forever. I think from an investment perspective, we like to chase performance. We might have really good returns, but if we learn that, our friend, our golfing buddy, whoever is getting better returns, then we our goalposts tend to change with it. And so, and from a life perspective, we are wealthier and healthier than almost any generation in history. Morgan Housel found that in the 1900s, 800 out of every 100,000 Americans died annually from infectious disease. By 2014, that number was 46. So that's a decrease of 94%. Kings and queens of the past, they didn't have electricity, air conditioning, trash removal, but we do. Yet I was looking at the happiness index. There's a report that comes out every year, which a lot of the data comes from Gallup. Shout out to Gallup. Shout out to my wife. And
We love you, Anna.
and 24th in the world in happiness. Charlie Munger once said, "The world is not driven by greed; it is driven by envy." And all of that to say is that it made me kind of have some introspection after reading the book, and this particular story made me just remind me when I grew up in El Salvador under the same roof. I lived with my great grandfather, my grandparents, my cousins, four of them, two aunts and uncles. And then when we moved back to America in Houston, Texas, I lived in a 144 square foot one bedroom apartment where I shared the same bedroom with my mom and my brother. And now, fast forward 30 years, my wife and I, we saved over 7 years to get the home that we have right now. Three bedrooms, 1,600 square foot, a condo. Big fan of it. Each of my daughters, two daughters, have their own bedroom. So praise the Lord. And sometimes I even think, hey, I would love to host people. Maybe we need more space. And then from Morgan Housel's book, he had a quote from Benjamin Franklin who said, contentment makes the poor man rich, and
Mm,
discontentment makes the rich man poor.
love that.
All of that to say that there's nothing wrong to have ambition, to want more, but to practice gratitude, that kind of fuels your joy. But comparing what you have with others, which is so easy to do in this social media age, that drains our joy. Your thoughts?
My thoughts, one, I love you, Gio. You're amazing. Thank you for the gift of perspective. And you remind me every day of the the power of living the American dream, the opportunity that we have in this country. Again, just getting back from Guatemala, based on some of the conversations I had down there, that I understand that the average income down there is around $300 a month.
Mm,
And these people have no money, but they have joy. They're just full of joy. They have servant hearts. They're servant leaders, just always smiling, always laughing, enjoying the moment. So again, a really great perspective. And I wrote down a number of things you made me think of. One, the great prophet Cheryl Crow. One of my favorite lines from one of her songs is, "Happiness is not getting what you want; it's wanting what you've got." And
mm,
I love you, Toots. Sarah and I always talk about that. Three, I think, key messages I wrote down just hearing you share that is that we talk about often is one, comparison robs us of our joy. Number two, money doesn't change you, it makes you more of who you are. And three, gratitude is the most powerful of all emotions.
mm,
And Gio, I'm super grateful for you. I'm
mm.
super grateful for this amazing country. I'm grateful for my family. We just have so much to be thankful for.
Yeah. Yeah. Agreed, agreed. Hey, by the way, we did not call each other to get the same shirts or the same blazer. This just happened.
It turned out great. Let's go.
That's so funny. Okay. With that, my friends, that wraps up our Compounding Wisdom episode for this week. If you have any questions, please send them our way, lwp@nm.com. And we will see you guys next time.
Have a great week. God bless.